In agricultural and food markets, trade is playing an increasingly important role. Because of this, we're going to spend the next couple of lectures talking about trade and looking at some examples that illustrate how economists look at trade and why we think it's important. There's no chapter in the book for you to read on this section, and so you're going to have to rely on these videos and also on the PowerPoint presentations. Now, what I want to emphasize is that we're going to be talking about trade, and that could occur between different countries, or it could occur within a country between different regions. And so really what we're talking about is the notion of the economics of markets over space and also trade. Now, as I said, trade is a major function in modern agriculture, and in fact it's one of the driving forces of Canadian agriculture and our food economy. Because of this, it's important to understand the direction of trade and also why trade occurs and who benefits. That direction of trade has become increasingly important as Canada has evolved to have a fairly significant position in global agri-food markets with respect to exports of food products. And again, I want to emphasize that we're going to be focusing on this notion of markets, but markets that are distributed over space. So think about markets in Ontario and markets in Manitoba and sort of the spatial relationship between those two different markets. Now, in order to understand the notion of markets over space and trade, I think it's important to have some definitions out of the way. We throw around exporting and importing quite often in the discussion of agri-food markets, but what do we mean? Well, when we talk about exporting, what we're talking about is sending out goods or services to another country. Now, it's not one country to another country, it's usually one firm to another firm, and so an exporting firm is a firm that is located in Canada who's produced some sort of a food product or an agricultural commodity and is exporting it or selling it to another firm in a different country. Now, sometimes firms will ship products from one country to another, but within the umbrella of their own firm. So for instance, Archer Daniels Midland might actually buy grain in Western Canada and ship it to a subsidiary company in Europe, and it's then going to be sold in Europe to a different company, beg your pardon. So this notion of export can actually be quite complicated. Importing is the same way, it's just that the flow of goods goes in the opposite direction. When one imports, what we're doing is talking about bringing in goods or services from another country. And again, I want to emphasize this isn't trade between one country and another country. This is trade between one company in one country and another company in another country. I think a more profound question and a more important question is, why are goods traded between regions at all? Why do we see trade? It's actually a really important question. One of the reasons why we see trade is that not all goods can be produced in all regions. For instance, we can't grow bananas or coffee in Ontario. At least we can't grow it economically. But we know that consumers like these products. In fact, more broadly speaking, consumers have a demand for a variety of different types of food products that either because of economics or because of climate, we're unable to grow in Ontario. What this means is that we could have unsatisfied consumer demand. When that happens, we might actually see importers respond by importing the product and selling it to consumers for whom there is a market. So one reason we do see trade is because we just can't produce all the goods that we'd like to consume within Canada or within Ontario. Another reason why we see trade in goods is that regional price differences may present profit opportunity. For instance, we often talk about buying low and selling high. Well, when price differences between two different regions are such that it's a very low price in one region and very high price in another region, it could be the case that those price differences justify shipping the product. And so it's really an issue of there's a profit-making opportunity that can be made by different people who are involved in the marketplace. Now on that latter point, what's important is the transfer costs. And really what I'm talking about here are transportation costs, or the cost of moving a product from one region to another region. Now I'm being clear here in terms of saying it's a transfer cost, not only just transportation costs. Transfer costs involve transportation costs plus all the other costs associated with moving a product. This could include brokerage fees, lawyer fees, any duties or tariffs that you'd have to pay to get the product into a country. So transfer costs are a lot broader than transportation costs. Now we're going to illustrate this with a couple of examples during class, but I want to talk about a few things here to try to get the point across. So let's consider an example where we have two regions. And in each region we have competitive markets. So we've got a perfect competition assumption. And in each region a homogeneous good is being produced. So for instance, it could be a bushel of grain in Western Canada versus a bushel of grain in North Dakota. And those bushels of grain are the same variety and have the same technical specifications, so they're an identical product. But if we have different equilibrium prices in each region, for instance, if the price in Canada is high and the price of grain in North Dakota is low, we have potential for there to be trade. Now, we're also going to assume in this discussion that it's not costless to transport, that there is a transfer cost borne in shipping product from one region to another region. What's going on here is that if trade occurs, if there's a flow of product, for instance, from the southern prairies into North Dakota in this grain example, then the difference between the equilibrium prices in those two regions will eventually exactly equal the transfer cost of shipping a unit from one region to another. So eventually prices are going to adjust to reflect that volume of trade until that last unit that's transported, the price difference associated with the last unit that's transported exactly equals the transfer cost. So at the margin, the price difference equals the transportation cost or the transfer cost. If trade doesn't occur, if we don't see trade occurring between those two regions, then the difference between those equilibrium prices in the two regions is either less than or is equal to the transfer cost of shipping a unit from one region to another region. And so really the relative prices in these two regions compared to the transportation costs, or if you want to call it the transfer costs, are very, very important. They're the fundamental driver of why we see trade in some goods and why we don't see trade in other goods. So there's some economic conditions that have to be true in order for trade to happen. So let's just assume that the price in region 1 is greater than the price in region 2. Trade will occur only if the differences in the prices is greater than or equal to the transportation costs. If price differences exceed the transportation cost, then there's an incentive to buy in the lower price market, ship to the higher price market, and sell at the higher price. And if you do that, and those price differences are still greater than the transportation cost, then you've earned a profit. So this notion of buying in a low price market and selling in a high price market is called arbitrage. And arbitrage is important because it underlies why we see prices changing when we allow for trade. In particular, through this arbitrage process, or the process of identifying profitable transportation flows, what we'll see is that that process will raise the price of the product in the lower priced market, and it'll lower the price in the higher priced market. And it'll continue until no further marginal profits can be made. So prices are going to adjust until the difference is exactly equal to the transportation costs. And so at the margin, when that last unit of product flows across the border, what we would expect to see is that the difference in prices is equal to the transportation costs. Now in class on Wednesday, we're going to go through a couple of examples. They're somewhat simple examples, but I think they illustrate the important underlying point that's going on here. One of them will take the perspective of shipping a product when we ignore exchange rates, and then another one will show what happens when we account for the role of exchange rates. And as it turns out, those exchange rates are very important. Now, one point that is one of these more profoundly important issues or concepts that I want y'all to remember is that if markets are working efficiently, if price discovery happens in a competitive manner and there's a quick and speedy identification of price and equilibrium discovery process, then what arbitrage means is that price differences cannot exceed transfer costs for lengthy periods of time. And the reason for this is if those price differences did exceed the transportation costs, in particular if the price differences were much greater than the transportation costs, we would expect the entrepreneurial process to kick in. People would identify that there's a profitable trade opportunity. They would buy in the low price market, sell in the high price market. Prices would then begin to adjust as those trades occur until such time that the price difference exactly equals the transfer costs. Now, this isn't to say that those price differences can't exceed the transfer costs. And in fact, in some cases, we do see price differences between different regions exceeding the transfer costs associated with moving a product from one region to another. Now, part of the reason why this might happen is that we might have incomplete or inaccurate information. Maybe it's the case that people who are buying in the low price market and selling in the high price market just don't know what's going on with the price in one or the other markets, and they're unable to identify those opportunities. There could also be a preference by some for goods from a particular area. So for instance, we see regional trade agreements where countries will sometimes say, I have a preferential trade status with respect to another country that gives importers preferential treatment with respect to bringing product in from some other country. There could be institutional and legal barriers, and in fact these are very important issues in the context of agricultural markets. The institutional barriers could be things like tariffs that are put on the products that are imported into a country, or it could be outright bans on products through some kind of a legal barrier, such as when markets were closed to Canadian beef exports when BSE happened. Other reasons why we sometimes see price differences exceeding transportation costs also relate to whether or not there's shortages in transportation or storage capacity. If there are shortages, then that would drive up those price differences, and you wouldn't necessarily expect to see an equality between those price differences and those transportation costs. Now, all of this is leading into something that's more broadly applicable to agricultural markets, and that's something that's called spatial equilibrium. And all spatial equilibrium is about is how you discover the price that might prevail in two separate markets and the volume of trade that would occur between those two separate markets given that price. Now, to do this, we need a little more formal framework that reflects the relationship between markets. Ultimately, what we're trying to do is determine the volume that's traded and what price will prevail in the marketplace. And the spatial equilibrium model we're about to talk about provides that needed framework. Now, we're going to make some simplifying assumptions to try to make things a little more transparent and easy to understand. We're going to assume that the markets in both countries are competitive. We're going to assume that there's only two regions. We're also going to assume that we have a homogeneous good produced and consumed in each region, and that there are no distortionary policies in place that would cause there to be some sort of restriction in trade. We're assuming that there's one market level, so this could be, for instance, done at the farm level or at the retail level. We're ignoring some of the complications that can arise when you have multi-level types of markets where you have a farm level, a wholesale market, and a retail market. We're also going to assume a common currency, so all these transactions are denominated in the same country's currency. We're going to assume linear supply and demand, and to make things very transparent and easy to see, we're going to ignore transfer costs. Now, all of these assumptions can be relaxed. The relaxation of all of them adds further complications, and it makes it much more difficult to deal with. My aim in this section of the course is to try to get you to understand this notion of spatial equilibrium and what we call the law of one price, and also try to understand why trade is important for agricultural markets, especially for Canada. Now, if we relax these assumptions, some of those similar types of stories still stay in place, but in order to understand how to relax these assumptions, you need to understand how the model works at a very basic level, and that's what we're trying to do here. So to get at this, let's think about two separate markets, and let's think about a case that economists call autarky. And in autarky, we don't allow for trade. So if we talk about autarky prices, what we're really doing is talking about the price that would prevail in each market should there be no trade. And what I'm showing you here are what those equilibrium prices in an autarky situation would be. So P1 star and P2 star are the respective prices for this good in these two separate markets when there's no trade. So these are prices in a closed market. And what you'll notice is that the price in region 1 is greater than the price in region 2. Now this tells us something that's very important, because it would tell us that there's an incentive to buy in the low price market, and the market for region 2's market, and then export that to region 1 and sell at a higher price. So region 2 would export to region 1. Now we can look at this the other way and say that region 1 imports from region 2. It's the same, we're saying the same thing, it's just that we're reversing how we're talking about it. The thing that's important is that product is going to flow from region 2 to region 1. Now this diagram tells us a lot. For instance, it tells us that if region 2's autarky price prevailed in region 1 and 2, it's clear that there would be an equilibrium in region 2, right? If this were the price that were relevant in both markets, there would be an equilibrium in region 2. But if we map that price across to region 1, what we see is that demand in region 1 would exceed supply in region 1, and we'd have a case of excess demand, and region 1 would not be in an equilibrium. So we know that the price that would prevail with trade wouldn't necessarily be P2. It's also the case that if region 1's price prevailed in both markets, there'd be an equilibrium in region 1, but there'd be no equilibrium in region 2. In fact, there'd be a case of excess supply. So if we map region 1's price over to the market for region 2, what we would see is that supply would exceed demand, we have excess supply, and region 2 would not be in an equilibrium. So you might be wondering, well, how does this help us? How does this help us discover what price we ought to be focused on and how we discover the price when we have trade? Well, I think what's important to recognize is that in one of these markets we're going to have excess demand. That's in region 1 when price is above P2 and below P1. When price is above P2 and below P1 in region 2, we're going to have excess supply. So region 1 has demand that could be unsatisfied, and region 2 has supply that's not being sold. And so what you might think of is trying to put these two pieces of the puzzle together in what we call a third market. We can think of this more generally by recognizing that in region 1, whenever the price is below the equilibrium price in autarky, that is P1 star, there's going to be an excess demand. Moreover, that level of excess demand rises as the price falls. So what this is getting at is that there's an inverse relationship between excess demand and the price that is prevailing in that marketplace. By the same token, when we think about region 2 at prices above P2 star, we have excess supply. And the level of that excess supply rises as the price rises. So what we're getting at here is that excess demand in region 1 behaves very much like we would expect a traditional demand equation in that it follows the law of demand. As the price falls, the volume of excess demand rises. By the same token, in region 2, excess supply follows a law of supply, where as price rises, the volume of excess supply also rises. Now we can use this to our advantage by trying to find an equilibrium price in the volume of trade. And to do this, we create what I would call a third market. In particular, we would create a market where we're trying to determine the volume of trade that would happen such that you have equilibrium prices in both regions. And what we do in this third market is we try to figure out what the excess demand from region 1 looks like, what the excess supply in region 2 looks like, and try to see where they intersect. That will tell us the quantity of trade that would occur and also the market clearing price that would prevail. Now that market clearing price doesn't just prevail in the market for trade, but through trade also prevails in the market for region 1 and the market for region 2. Now what's important here is that we're invoking this price-taking assumption. We're assuming that the market clearing price determines quantity demanded and quantity supplied in each region. If there's market power or any kind of distortions to the price in this third market that reflects trade, then it's not necessarily the case that this model would hold, and we would have to make some adjustments to get at this notion of an equilibrium. But let's illustrate this. Let's use our original diagram, but now what you see is that between region 1 and region 2, I've drawn a market that I called the trade market. And let's take a focus first on trying to derive the excess demand curve. We know that when the market price in region 1 is equal to P1 star, that quantity demanded is going to equal quantity supplied. And so excess demand would simply equal 0. And I'm showing this by extending the price of P1 star into the market for trade and showing the volume of trade, or at least the volume of excess demand at that price, would be equal to 0. If the price in region 1 fell, let's say to the second blue dotted line, what we know is that there would be an excess demand equal to the difference between D1 and S1. We can map that in the market for trade by placing a dot reflecting that volume of excess demand at that particular price right here. If we did that for a third price, we would follow the similar kind of logic and note that at that even lower price, excess demand is even higher, and so what we could do is draw another dot that represents the volume of excess demand at that third price in the market for region 1. If we did this for all prices that might happen between or below P1 star, and then we connected all those dots, what we would get is a curve that we call an excess demand curve. It shows the demand that is not met by domestic production at prices below P1 star. Now, that's one side of this market for trade. We need to think about what the other side of the market for trade is, and that's where we have to look at the market in region 2. We know that in the market for region 2, if the price P2 star prevailed, quantity supplied would equal quantity demanded, and we would have 0 excess supply. That's what I've drawn on the trade panel here, where we've mapped price P2 star over to the trade model market, and we show a volume of trade equal to 0. That is to say, there's 0 excess supply. For any price above P2 star in the market for region 2, we're going to have excess supply, and we can map that volume of excess supply into the market for trade, as I've just done here for the second price in the market for region 2. If we did that for a third price in the market for region 2, what we would see is that the volume of excess supply grows as the price goes above P2 star, and so we've got a third dot. And again, we could do this for all different price levels above P2 star and then connect those dots, and what we would get at is something that we call an excess supply curve. That upward sloping excess supply curve in the trade market reflects the volume of unsold product that's available in region 2 at the respective prices. So what's important to recognize here is that excess supply shows what region 2 has to offer outside of its domestic market, and excess demand shows the unmet demand that can't be met by domestic production in region 1. And so it stands to reason that because region 2 has an excess supply and region 1 has an excess demand, that there's some happy medium in between the two where trade would occur and you would discover an equilibrium price. And in fact, that's what economists do when we focus on trying to talk about trade, is we're looking for the point where excess supply equals excess demand. At that point, we're going to have an equilibrium level of trade. And that equilibrium level of trade is also going to result in what we call a market clearing or an equilibrium price. And that price is going to prevail in the two different regions. It will prevail in region 1 and in region 2. So I'm going to draw what that equilibrium price P star would be. Now what's important is P star, that pink equilibrium price, is determined solely on the basis of the quality of excess supply and excess demand, and it's then transmitted to the two different regions. Now you'll also notice that the price in those two regions are equal to each other. This leads to a very, very important concept in food and agricultural markets called the law of one price. And what the law of one price says is that the same price will prevail in two different regions when markets are working efficiently and we have an equilibrium. Now we can do a lot more with this model than just try to figure out what the equilibrium price is going to be. So we know, for instance, that where excess supply equals excess demand at price P star, there's going to be some volume of trade. And that's going to be denoted by T star. So what this says is the market is going to clear at price P star, there will be a volume of trade T star. And that volume of trade will actually reflect what's being exported from region 2 over to region 1. And so we can expand on this a little bit more by saying, all right, what happens in region 1 and region 2 in terms of quantity supplied and demanded when there's a price of P star? At P star, we're going to have a quantity supplied in region 1 equal to S1 star. As well, we're going to have a quantity demanded in region 1 of D1 star. By the same token, in region 2, we're going to have a quantity demanded of D2 star and a quantity supplied in region 2 of S2 star. Now what's important is that T star equals the difference between demand and supply in region 1, and it has to equal the difference between supply and demand in region 2. The reason for this is that at P star, the equilibrium level of excess demand is equal to T star, and at that same price, the equilibrium level of excess supply is equal to T star. So these differences have to be the same in order for the market to clear. Everything that is not bought in the domestic market in region 2 is an excess supply that's sold in region 1, and that satisfies the unmet excess demand. And so we have a balance between these two markets. So the other thing that's really cool about this is that we know that we have to have an equilibrium where excess demand equals excess supply. So this trade market is what ties everything together between these two markets. And if there's anything that goes on in that trade market, like a tariff or like a tax or an import quota or an outright ban on trade, that's going to distort these prices, and we'd have to figure out what the new equilibrium or at least market clearing prices would be in these two different markets. Now we can say a lot more about this because we can also think about the gains from trade arising through welfare. So we could calculate what producer and consumer surplus is in region 1 and region 2 with autarky and then compare that to the free trade equilibrium. So let's think about what happens in region 1 first. If we go from a price of P1 star to a price of P star, we know that the price in region 1 has fallen. What that means is there's a reduction in quantity supplied, but an increase in quantity demanded. That reduction in quantity supplied means that producer surplus falls, and it would fall by this yellow trapezoid that I've just shown on the screen. Now what's important about that trapezoid is that that is an amount of producer surplus that's transferred to consumers. So producers are worse off because they have a lower price. Consumers have an increase in surplus because their price has gone down, and part of that increase in surplus comes from a transfer from producers. But there's also a creation of new benefits, new economic benefits in the market for Region 1 because the price is now lower. In particular, this green triangle represents what we call the gains from trade in the importing region. And what you can see is that that's a consumer surplus. And so consumers are unambiguously better off, but producers are worse off. But as a society, everyone in Region 2 is better off in the sense of there's been an increase in total welfare. We can think about doing the same kind of analysis in Region 2 where we know that price has gone up. So price went from P2 star to P star. What that does is it reduces the quantity demanded from Q star 2 to D star 2, but it increases quantity supplied from Q star 2 to S star 2. So we know, for instance, that there's a transfer of surplus from consumers to producers in Region 2 equal to that beige trapezoid area that I've just illustrated. Consumers will be worse off, and they're worse off, we know they're worse off because prices have gone up. Producers are going to gain some new welfare that they didn't have previously. But there will be an additional gain to total surplus in Region 2 through trade. That is, there will be an increase in welfare that reflects the gains from trade in Region 2. And that's going to be equal to this purple triangle. And what you can see is that that purple triangle is actually a producer surplus. And so producers are unambiguously better off in Region 2, and consumers are unambiguously worse off in Region 2. But on balance, when we calculate total surplus, we know that everyone, or the market in Region 2 has a higher level of welfare. This latter point, the gains from trade, is really, really, really important. It underlies everything that we've been working on as a sector in terms of trying to open up markets. Because what we would hope is that Canada, which traditionally has an export role, very much like in Region 2, by opening up markets, will actually try to increase producer surplus arising through trade. Now, we're going to talk a lot more about this in lecture in the next couple of days, so don't lose sight of the fact that we can apply all of those principles of welfare analysis that we talked about in the context of trade. The other thing we're going to do in class is we're going to work through an example. Now, this is a lot of algebra, and so what I want to do is give you a sense of what we're going to do with this. So what I'm going to present to you in lecture is a situation where we have two regions, Region 1 and Region 2, and we've got a demand curve in each region and a supply curve in each region. And what we're going to do in that example is try to figure out who imports and who exports, what's the market clearing price, and also what are the market clearing quantities in each market, and what's the volume of trade. This is a great time to stop, and so we'll pick up with this stuff in class probably starting on Wednesday.